morning, everyone, and welcome to today's section hosted by Shelze Professional Services. This is the second in our Shelze Fiscal webinar series, and today's session examines a question that affects every organization that pays VAT or files CIT returns. Are you recovering everything the law entitles you to, and are you confident that what you are deducting will survive a Nigerian Revenue Service audit? Before we begin, let me introduce our speakers. Our first speaker for today is David Apaflo. David Apaflo is the Managing Director of Shelze Professional Services. He is a member of the Institute of Chartered Accountants of Nigeria and also a member of the Chartered Institute of Taxation of Nigeria and IMC. David Apaflo holds a BSc in accounting in the University of Lagos. Our second speaker is Iyanuoluwa Majonagbe. Iyanuoluwa is a manager in Shelze Professional Services, and he also supports every tax advisory services in line with the NTA 2025. We would run a few quick polls during this session to keep things interactive. Your responses are anonymous, so let us begin. Let me quickly start with a quick scenario. A Nigerian company imports consulting services from a UK firm. The invoice is £50,000. The company pays the invoice but does not self-charge VAT. What is the tax consequence? So for our first poll, the question says, what happens when a company pays for imported services without self-charging VAT? Option A says nothing. VAT only applies to domestic transactions. Option B says the company loses the right to claim impute VAT on that transaction. Option C says the company owes VAT to the NRS plus penalties. And option D says all of the above would apply depending on the circumstances. So I'll be giving 1 minute for us to give our answers to this question. Interesting speed of answers. Let's unpack what is actually happening here. So I will hand over to David Apaflo to give us and shed more light on the tax consequence. Over to you, Mr. David.
Thank you very much, Ife, and thank you and good morning to everyone joining us today. As we've seen from the poll results, there really is no consensus on what happens in that scenario, even though there really should be, because we're talking about tax laws here, and so there should be a consensus on what the position should be. And this is exactly what we're seeing across businesses in Nigeria right now, because the Nigerian Tax Act has come with a lot of changes. Business is no longer the way it used to be. The VAT framework and CIT framework have changed, a lot of things that we do, and they created 3 simultaneous exposures for businesses. The first exposure is that many businesses are not claiming the input VAT that they are legally entitled to. Now, if you're not, legally claiming the VAT input you're entitled to, it means that you are overpaying and you are leaving some money on the table. The second thing is the self-charge mechanism for imported services or even for services where you are not charged a VAT. This particular provision, is widely misunderstood. It's been in the laws before the Nigerian Tax Act. It's been revamped a little bit. And, companies that ignore these provisions of self-charging they face vast assessments and penalties that could run into millions and billions, and they even lose the legitimate input VAT that they might be able to claim on those transactions. The third and final one is that, some expenses that might seem deductible on the face of it for CIT purposes might be disallowed during an audit because the documentation does not meet the new standards or the new requirements that the Nigerian Tax Act, has provided for. So a particular transaction or a particular expense that would have been deductible, or a particular transaction structure within the Nigerian Tax Act, before the Nigerian Tax Act, might now be disallowed under the Nigerian Tax Act. So what really looks like a valid deduction, on paper, can become, a tax exposure or an adjustment in practice. And this is not just theory, because what we see in taxation is the laws come alive when when it's time for an assessment or an audit by the relevant tax authorities. And so this is what we're seeing with engagements across different organizations right now. And we thought it would be good to shed light on some of these areas so that you stop leaving money on the table. So Iyanu is going to walk us through each of these areas in detail, giving us the specific provisions, the practical implications, and what you really should be checking for in your organization. And I hope you learn a thing or two today. So thank you very much. Over to you, Iyanu.
All right, thank you very much, David. Good morning, everyone. We've been able to put this into different areas, into 4 different areas. But let's start with the first one, VAT input claims. All right, this is where most organizations are leaving money on the table without even realizing it. Right. So under the NTA 2025, the right to claim input VAT is not automatic. You see, there are specific conditions that must be met, and I'll walk you through them. So the first condition is that VAT must be charged on a taxable supply. So this sounds obvious, but in practice, most businesses are paying VAT on items that are either VAT exempt or zero rated under this new act. Right. So if VAT is incorrectly charged on such supplies, it does not qualify as recallable input VAT. What this means is that you cannot claim it as input VAT. I mean, if you paid it, but the law does not recognize it, then it means it's invalid. So what this means is that to claim input VAT, you must have suffered and paid that VAT on only VATable items. The second condition is that the VAT supply must be for the purpose of the business. So prior to this NTA 2025 Act, right, the right to claim input VAT in Nigeria was largely limited to VAT incurred on goods and services used in the production of taxable supplies. That's where you see a company claiming input VAT only on cost of sales items. See, but this new act has significantly broadened the scope. So what this means is that it permits VAT registered business to recover input VAT suffered on qualifying business expenses and even on purchase of fixed assets, provided these inputs are used while making taxable supplies. So you see that, and I'm sure you agree with me that this is a meaningful change. What this means is that VAT paid by a company on professional fee or even purchase of, let's say, PPE or motor vehicle for business purpose is now potentially recovered against output VAT. But you see, the act is explicit, right? Input VAT is only recoverable on supplies that are directly attributable to taxable business activities. But the mistake many businesses make is to claim full input VAT without apportioning. We'll get to that in a bit, but this is a red flag on audit. So if your organization makes both taxable and exempt supplies, you must apportion. The next condition is documentation, which is very, very important, right? You must hold a valid tax invoice that meets the requirement of the Act. So, recent time, the NRS has been increasingly rejecting input claims where invoice does not contain the supplier's thing. It does not contain the correct VAT amount or even the description of the supply. So, for an invoice to be accepted by NRS, it must have these things in it. It must have the supplier's thing. It must have the VAT rate and the amount. It must also have the description of whatever it is that you are getting, whether it's the service or the goods. So let's not mistake a receipt for an invoice, right? A receipt is not an invoice. The pro forma is also not an invoice. But in cases where companies import goods, right? For imported goods, sure, you must have paid VAT to custom service, to NRS while clearing these goods. And in this case, you need to document your custom papers that shows you the import duties. It shows other payments that you've made while clearing your goods, right? So this payment forms the basis of your input tax credit. So again, there are also limitations to input VAT claims, right? So the Act has stated that where a taxable person incurs input VAT on expenses used to make both taxable supplies and non-taxable supplies, the input VAT cannot be fully claimed. So only a portion of this amount of input VAT that relates to this taxable supply is what will be recoverable. So in essence, right? So if you ask me what a taxable supply is, so a taxable supply, right, in Nigeria, so in respect of goods, right, because both goods and services can be classified as taxable supply. So in respect of goods, taxable supply would be goods that are physically present in Nigeria, or goods imported into Nigeria, goods assembled or even installed in Nigeria at that time of supply. Those are taxable supply. And in respect of service, right? So if the service is provided to you and consumed by a person in Nigeria, regardless of whether the service is rendered within or outside Nigeria, it will be considered as a taxable supply. There is also a 5-year rule for input VAT, right? So the Act has introduced a time for claiming input tax credits. So as it stands now, input tax is only allowable for deductions within 5 years after the end of that tax period in which the input tax was incurred. Right. Also, please note that this is limited to taxable supplies made as from the commencement of this Act. So here is a practical problem, right? Many finance teams process invoices for payment, but do not verify whether this invoice qualifies for input VAT recovery. You see, the VAT is paid, right? But the expense is booked, but the input is never made. So, if it is made on an invoice that will not survive an NRS audit, it means that the input VAT will be difficult to claim. So the first thing I will encourage every finance team to do after this session is to review your last 6 months of VAT returns, look specifically at areas where there are vatable inputs where you did not claim, and for claims, and for the claims that you made, ask yourself, does this documentation meet the NTA 2025 standards? If this question resonates with you, then you can know whether to go ahead or if you are the right path or not.
Thank you so much, Iyanu, for that detailed explanation. So we'll be moving on to our second poll. And the question says, does your organization currently have a process to verify that invoices meet the NTA 2025 requirements before claiming input VAT? The first option says, yes, we verify every invoice. The second option says partially, we check some, but not all. The third option says no, we claim based on payment records. And the fourth option says not sure. So I'll be giving 1 minute for us to pick our answers to this question. Thank you. That puts us ahead of like most organizations we work with. So let's see if the next area we work on. I'll be handing you to explain the self mechanism. Iyanuoluwa.
All right, thank you, Ife. Now let's move to the second area. All right, and this one is the one that catches most organizations off guard. It is the self-charge mechanism. So the NTA 2025 imposes a self-charge obligations on buyers where a supplier fails to charge VAT on a taxable supply. So this is not a new law in Nigeria. Let's not mistake that, right? It has existed even before the NTA 2025. But its formation under the new NTA 2025 and its direct linkage to CIT deductibility has significantly elevated the compliance stakes. So now, self-charge is a well-established mechanism in international VAT systems. And the mechanism works as follows. So first, you receive an invoice from a supplier for a taxable supply with no VAT charge, but are required to apply other VAT rates, 7.5% to the VAT of the supply and account for this as output VAT payable to NRS. So when you do this, right, you record the equivalent amount as input VAT because you are entitled to recover this amount, right? So in this case, you have an output VAT, you have an input VAT. The net VAT position of this transaction would be 0 if you had done it properly, right? The output VAT you emit equals the input VAT you are going to claim. So what it means is you remit the self-charge VAT to NRS via your periodic tax returns. So if this is done properly, right, it might not even involve movement of cash from your account, right? So let's remember our opening scenario, the UK consulting service, right? So let me explain what the law actually requires. So under the NTA 2025, when a Nigerian company receives a service from a non-resident supplier, be it consulting, technology, professional fees, management fees, or even royalty, right? The Nigerian company is required to self-charge VAT on that particular transaction. So you are expected to account for the VAT as if you were both the supplier and the resident. So like we stated on our slide, if as a supplier fail to charge VAT and you do not self-charge VAT, you have not suffered the VAT. So what this means is that you cannot claim into VAT on the transaction. Even worse, right? The entire expense that you've incurred for this particular transaction may be disallowed for CIT purpose. You see why the self-charge VAT is not just a compliance formality anymore. It is a critical step that protects the deductibility of your expenditures. So, and then people ask me, well, why does this matter? Why do I need to self-charge myself when the net result to be zero, right? So here is why it matters. There are three consequences if you do not self-charge. So the first one is NRS can assess the VAT against you with penalties and interest. So what this means is you hold the VAT and you do not pay it. The second one is you lose the rights to claim the corresponding input VAT on that transaction. If you had self-charged in the first place, you would have been able to claim into VAT on that transaction. But now that you didn't self-charge, you've lost that right to claim input VAT. So the self-charge is both liability and the potential recovery has gone. So if you never create the liability, you cannot recover it. So the third one is if the expense is also being deducted for CIT purposes, right? Failure to self-charge on that expense can cause them to disallow that expense, which again has created another exposure for you. But that will also come to that in a moment. Right. So let's talk about interpersonal, intergroup transactions. Right. This is also very relevant for organizations that are part of multinational groups. Right. So of course we know that they are going to have a management fee, they are going to be shared services, technology licenses, and all of that. All of these transactions can trigger the self-charge obligation if the service provider is non-resident. Right. So what we are seeing in practice today is that many organizations book these expenses and they deduct them for CIT purpose, right? But they never account for self-charge VAT. And you see, when NRS now comes for audit, you'll find both the VAT liability and the expenses you've allowed for CIT purpose. You find those two in question. And then in the case of audits, they can disallow your expense because you didn't charge VAT on it, right? So let's paint the scenario. So, first scenario is where the supplier charges VAT correctly. So on your invoice, let's assume you bought an office furniture for 2 million naira, right? And then the supplier charges VAT on that invoice. 7% of 2 million will give us 150,000, right? In the VAT rate. So in your books, you recognize 2 million as your cost of assets, right? And for your VAT input recoverable account, you recognize 150,000 naira in the debit side of your account. And then for your bank or accounts payables, you recognize 2.15 million naira. Right. So in this case, when the company files VAT returns, right, the 150,000 input VAT, he can use that to offset his absolute VAT liabilities. But in his book of accounts, the fixed assets is going to be carrying 2 million naira on the balance sheet, right? So you see that in this case, VAT is not capitalized. So unlike before, VAT used to be capitalized, but this new act has made it in a way where you can claim input VAT on cost of on not just cost of sales items, you can also claim improved VAT on any business expenses that you incur and even on fixed assets. So let's assume in this scenario, the supplier did not charge VAT, right? You have a transaction of 5 million, you had a consulting service, and then they charge you 5 million for that, and they didn't charge VAT on it. You're expected to self-charge VAT for this transaction, right? So again, the accounting treatment is the same. So in the case of 5 million naira consulting fee, your expense should have 5 million, right? Your VAT input recoverable accounts should have 375,000 being the VAT element, and then the VAT output, you should also have that same 375,000 naira. And then for your accounts payable, you have 5 million. So in this case now, you can see that cash was involved, right? You self-charge. So when you self-charge, you are able to offset the input VAT with your output VAT, which gives you a net a zero account value. So on the other end, we are just trying to show you the implication of self-charging, because some people think that it's extra cost to them when they self-charge VAT, right? It's not an extra cost because you are offsetting the input VAT from the output VAT. So again, right, there is also a 5-year limit for input VAT, right? This is kind of like a limitation to these things. So we talked about the 5-year limit earlier, right? Given the 5-year limit for input VAT that we talked about, this is where your FIFO method comes in, right? For the best utilization of your input VAT claims before the 5-year period elapsed, right? So the FIFO method is the first in, first out method. So you claim your input VAT that has happened. So for people who can already fully claim their input VAT, right, can roll over to the next year, right? So in that case, you can claim the input VAT for the next period. Okay. So another good thing again is that you can even apply for a refund. So in the case where you've been carrying over input VAT, your input VAT has been so much that you have to be carrying over the input VAT year in, year out for different period, you can get a refund. You get, so it doesn't mean that you elapse the full 5-year period, right? So with proper documentation and presentation, you can easily utilize all your input VAT and not lose money. You get. So what we are seeing in practice today is that many organizations put these expenses and deduct items. They deduct all these expenses for CIT purpose, but they never account for the self-charge VAT. And then when NRS comes now and do audits, they find both the VAT liability and the CIT expense. They find both of them in question because the right thing has not been done on that account. At this point, we would take another poll while I hand over to Ife.
Thank you so much, Mr. Iyan, for doing justice to that. So we'll be running our third poll, and the question says, your company paid 100 million naira to the UK firm for technology licensing. You did not save. What is your total potential exposure? The first option says charge the 7.5% impact. That is 7.5 million. The second option says VAT plus penalties plus lost input claim. The third option says VAT plus penalties plus lost input claim plus possible CIT disallowance. And the last option says no exposure. The UK firm should have charged VAT. So we'll be giving 1 minute for us to answer this question. Thank you. So the correct answer is C. And this is the cascading effect Iyanuoluwa has just been describing. One misstep will create 3 separate exposures. So I'll hand back to Iyanuoluwa to talk more on the CIT deductibility track. Over to you, Iyanuoluwa.
Yeah, no, I think you need to unmute your mic. You've been muted since the last poll, so you need to unmute your mic. You've been muted since the last poll.
Thank you, Ife, once again for that. Now let's look at the third pillar, CIT deductibility. And this is where the financial impact really compounds. Under the NTA 2025, not every expense that appears on your profit and loss statement is deductible for CIT purposes. So the Act has set specific conditions, and NRS is applying them with increasing rigor on audits. Before now, for the deductions to be allowed for tax purposes, they need to pass the rent test, right? What it means is that the expenses has to be wholly reasonable, exclusively, and necessarily incurred for the business. Now, reasonably and then necessary has been expunged. So now, expense must be wholly and exclusively incurred in the production of income. The Act has only tightened the application. So expenses that are partly personal, partly business, or that does not benefit a related party without clear communication justifications, these expenses are going to be disallowed. And then for transfer pricing implication, right? So if you have intergroup payments like management fee, royalties, you have shared service costs, all of these are going to go through scrutiny by NRS, right? So if the pricing system is not at arm's length, or your transfer pricing documentations are not complete, or they are not really sufficient to support your claim, NRS can disallow these deductions. And it is not just the excess amount, they can disallow the entire amount. And then this is where the documentation trap comes in. Right? It gets practical in this instance. Yeah? An expense can be genuinely incurred. Right? It can be only for the business. It can be exclusively for the business. It can be at arm's length. But if you don't have supporting documents to substantiate these expenses, you don't have documents that meets the required standard of the NTA Act, NRS can still come and challenge these expenses, right? They can still come and disallow these expenses. You get so board resolutions, service agreements, evidence of service deliveries, your transfer pricing benchmarks, all of these things, right, are really documents that you should put in place, not just for yourself, but for future purpose, for NRS audits, and for other things that you might need them to do. So before we move on to our final pro, right, I want to bring these 3 areas together, because this is where the real cost actually sits. let's take a single transaction. Let's say your company pays a non-resident management fee of 100 million naira. If you do not self-charge, three things would happen simultaneously. So one, you owe VAT to NRS plus interest and penalty. So on that 100 million naira, the VAT element alone, which is 7.5%, is 7.5 million naira. The second thing that will happen again is that you lose the corresponding input VAT claim. So the money you were entitled to recover, now you can't recover it again because you didn't self-charge. So if you had self-charged, you would have been entitled to that 7.5 million input claim. Right now, that one has gone. The third one is that NRS may question the expense. If you had allowed it before for CIT computations, they might disallow it, especially if the transfer pricing document is not even sufficient. So what it means is that the load amount can be disallowed for CIT purpose, and CIT rate is 30%. So if you do 30% on that amount that was disallowed, that's already 30 million naira that you've lost. If you add all of this together, you already have a potential liability of 45 million naira. You see, this is what we call the double cost. So the same compliance gap that creates a VAT liability also eliminates a VAT recovery and puts CIT deduction at risk. What this means is that once you miss a step, right, you can fall into 3 financial consequences. And this is a trap. And most organizations don't see these things until audit comes. So now let's look at the scenario of a compliant versus non-compliant treatment. So on the 10 million naira expenses, right, where you self-charge, let's assume that you incur an expense of 10 million naira and you self-charge. VAT is at 7.5%, right? So if you self-charge at 7.5%, that's 750,000 naira. So it means is that the full CIT deduction of 10 million is going to be allowed. So it means you have a CIT savings of 3 million naira if you are going to compute it at 30%. Because it's an allowable deduction, and so you have a 3 million naira CIT savings. So if you add all of these considerations together, this treatment alone would give you a net economic cost of 7 million naira. So now let's imagine you did not self-charge. First off, you've already created a CIT exposure of 3 million naira, because if the 10 million is disallowed, it means that there's already a 3 million naira CIT exposure, right? So in addition to that, you already have a 750,000 naira VAT that you do not account for. That alone is already a liability, excluding the interest and penalty. So in that case, again, you don't have the right to even recover this VAT because it's self-charge. So if you look at the total cost of non-compliance for this particular transaction, to give you a 10 million that was the total 10 million that was disallowed, 3 million you could have saved, 750,000 VAT that is now an expense to you, a liability to you, to give you around 13,750,000 naira. You see why we can't overemphasize the importance of compliance. And I usually tell people that non-compliance is usually more expensive than compliance, because people think we are avoiding if you want to evade this tax, you want to do this, you want to do that. By the time audit comes looking for you, by the time you calculate the interest and penalty, that is even more than what you could have actually paid once. So I'll allow Ife to go over the last pool before we take the final. So,
Thank you so much, Iyanuoluwa, giving us this detailed explanation on the CIT deductible and CIT deductibility. I hope we are learning and we are writing, because I am. So I'll quickly run our last poll for today. And the question says, your organization conducted a comprehensive review of its VAT input claims, self-charge compliance, and CIT deductibility positions under the NTA 2025. The first option says, yes, fully reviewed and documented. The second option says, partially, some areas reviewed. The third option says, no, not yet reviewed. And the last option says, not sure. So we'll give 1 minute for us to provide answers to this question. Thank you. Thank you so much. And this result tells a clear story. So I will hand back to Iyanuoluwa to tell us more on the advisory bridge on what we can do. Over to you, Iyanuoluwa.
all right, thank you, Ife. See, those results are consistent with what we are seeing across the markets. So most organizations have not yet conducted a structural review of their VATs and CIT position under this new act, which is understandable, right? Because the act is still new, and then the practical implication might take time to filter through. But what we are finding in practice is that the organizations that are most exposed tend to share a few common patterns. So you've noticed that for these organizations that share the same pattern, their input VAT claims based on payment records rather than qualifying tax invoice. So their imported services processed and paid without self-charge VAT being accounted for. Their intragroup charges deducted for CIT without adequate transfer pricing documentation. And then again, you also notice that there are really no formal process linking their VAT compliance to their CIT deductibility review. Let's not even forget about the penalty for awarding contracts to any person or entity that is not registered for tax. So the law states that any company or statutory body that awards a contract to a person or entity not registered for tax is liable to pay an administrative penalty of 5 million naira. And this is per transaction, not even per customer or per month or per year. So you can imagine having multiple transactions with with businesses or entities that are not registered with tax. You can be facing a cumulative penalty of tens and hundreds of millions, depending on how much transactions you've had with any of these entities. And for small business, small business, it's annual turnover of 100 million or less are exempt from the obligation to register VAT, to charge VAT, or even to file monthly VAT returns. So before now, classification of small business was 25 million naira, but the Act has increased the threshold for small businesses based on economic reality, based on present realities, right? So, again, the Act has been clear, right? So any business providing professional service cannot be classified as a small business. So if you're an individual and you render professional service, so professional service like legal service, accounting service, tax service, medical line, or even architectural services, right? You cannot be classified as a small business. So if you are rendering a service for someone, you must charge VAT on those services, regardless of whether your annual turnover is 100 million or less or more. You cannot be, if you're rendering a professional service, you cannot be classified as a small business. So, however, it's for small businesses who want to, who qualifies or who are exempted from VAT can voluntarily opt into the VAT regime, right? If you want to be claiming into VAT. So you can write to NRS that you want to register for VAT, you want to be changing VAT, and you want to be charging VAT. So you can't voluntarily opt in for that. So in this case, right, we agree that small businesses are exempt from paying VAT. Right? So what happens to these people is transacting with these small businesses, right? So if you're a large company, they are transacting with the small business that is exempt from VAT, you are expected to self-charge VAT. Yes, so it still brings us back to where you self-charge VAT, where it's a vatable supply, but VAT is not charged on the invoice. So organizations that recognize these patterns, right, the most effective starting point is typically a targeted VAT and CIT compliance review. That is just it, because this is a focus area. It's not a full-scale audit that identifies the specific gap. You don't need to do too much before you know that, there's a gap in this place. You are supposed to check your exposures, you identify where these specific gaps might come. You quantify the exposure, and then you map out steps that you can take to curb these things later in the future. Map out the remediation steps that you can do. So if any of these issues resonate with your organization, our team is always available for a brief, no obligation conversation to help you assess your position. So what you have to do is simply reply to the follow-up email you're going to get after this session.
Thank you so much, Ian, for that. So we have a few minutes for questions. Let me check the Q&A part. We have one question from Francis, and it says, what services are input VAT claimable in line with the NTA 2025? Over to you, Ian. So I would come again. We have a question from Francis, and it says, what services are input VAT claimable in line with NTA 2025?
All right, thank you, Ife. So I earlier explained what taxable supply is. So any taxable supply that you incur VAT on can actually claim input VAT on them. And then I said again that with this new law, it has brought a good development. So before now, you could only claim input VAT on cost of sales item. So right now, if you incur VAT on any business expense, so any business expense at all that you incur VAT on, so be it professional fee, because before now, you can't claim input VAT on professional fee. Before now, you can't claim input VAT on cost of sales item. So any expense that you incur for your business, that you've incurred VAT on, you can actually claim input VAT on these things. And let's not forget about our documentation process too, because to claim input VAT, you must need to prove that you actually incurred VAT for this particular expense, and then you must show documentations to prove that. All right, thank you.
Okay. Thank you, Iyanu. I hope you did justice to that question. Then we'll be taking another question from Victoria S. And the question says, if we discover that we have not been self-charging VAT on imported services for the past 2 years, what is the best way to regularize this with the NRS? I'll take that again. It says, if we discover that we have not been self-charging VAT on imported services for the past 2 years, what is the best way to regularize this with NRS? So over to you, Iyan.
So I'll say the best approach is to initiate a voluntary disclosure to NRS, right, before audit comes or before investigation comes, right? So, and then again, moving forward, you're expected to self-charge VAT on any other invoice that you incur after that, right? And then you're also expected to have your documentations. Like I said, documentation is very, very important. To when you self-charge VAT, you are expected to also have these presentations in your accounts. Let it show on your ledgers, let it show your bank statements. So basically, in this case, right, I would advise that first off, you check the liability, right? Look at the exposures, look at how much VAT that you also have self-charged, but you didn't. So I mean, that's the first step. So you are taking steps back to try to correct the wrongs, right? So you need to check these exposures that these areas where you're already exposing. So check, try to compute your liabilities. Again, you can also compute interest and penalty on it too, because when audit comes to and then found liable or you have VAT dues, it's going to be calculated with interest and penalty. So again, after that, you formally do like a voluntary disclosure. You submit this to NRS, tell them that, oh, you have this this VAT that you also have paid, and this is the amount, and this is how much you've paid, and what have you. So that is what I would just do. And then moving forward, you try to mitigate this risk by doing the right thing and then by having the sufficient documentations.
Okay, thank you so much, Iyan. So because of time, we'll be taking just one more question. So I would take the question from Dala, and the question says, is there a time limit for claiming input VAT that was previously unclaimed. I will come again. The question says, is there a time limit for claiming input VAT that was previously unclaimed? Over to you.
Okay, thank you, Ife. So this question is interesting, right? But according to the NTA, the new tax laws, right? I'm guessing this person asked because of the 5-year limit, right? So this 5-year limitation applies to transactions that happened after the commencement of this act. If you have incurred input VAT after the commencement of this act, you can roll over for as much as 5 years. So the limitation is 5 years. Like I said, you can always claim a refund. If you cannot if you cannot claim the whole input VAT on your output VAT, the input VAT is too much than your output VAT, you can always claim a refund. Okay.
Okay, thank you so much, Iyanu, and I hope it did justice to our questions. So if we do not get to your question today, we will definitely address unanswered questions in the follow-up materials. Thank you.
All right, thank you, Iyanuoluwa, and thank you, Ife. I see that there are still a number of questions in the chat box. Unfortunately, we're trying to keep to the time, so we might not be able to answer all the questions within this session. But as Ife has,
over to you.
Okay, so as Ife has mentioned, in the follow-up materials, and in as much as we can in the chat box, we will be answering some of those questions, but we might not be able to take all those questions because of our time. Our time is fast spent. We're trying to keep to the 1 hour promise that we made for these webinars. So thank you, Ife. Thank you, Iyanu. I think you've done justice to today's session. So I just want to close with four important things. The first one is that we need to note that the input VAT recovery is not automatic, right? So there are conditions, there are criteria that you need to be able to meet, and to be able to help verify the invoices against those conditions. If not, you might not be able to claim your input VAT. And if you're unable to claim your input VAT, then you're leaving money on the table. Also, as I saw a question within the chat box about e-invoicing. Of course, an invoice that is put on the e-invoicing platform makes it very easy for you to claim your input VAT because it's showing that transaction really existed. The two parties in the transaction have consented to it, and NRS has a record of that transaction. The second point is that the self-charge mechanism is not optional. If your organization pays for services from residents or if an organization pays for services from residents, then it is important that you actually self-charge and remit those the input VAT or the VAT to the tax authorities. It's really important that happens. So it's very important that we take away those two things. The third one, can you guys hear me? Okay, so third one is that some of these issues can compound, where moving from VAT, we then have a situation where the CIT also, you might have disallowed expenses for CIT because you didn't charge VAT on certain transactions. And so that's what the Nigerian Tax Act has said to us, that if you don't charge VAT on a particular transaction, then you might not be entitled to claim that expense as an allowable expense. And the fourth and final point is that all these three items actually interact. The input VAT recovery, the self-charge mechanism, the deductibility, they all interact, and of course they all have a pull and a drag on your financial resources. Before we go, as it's just a minute after 12, all participants will receive our VAT and CIT compliance quick check, which we've developed to help you evaluate your organization. And this is a practical tool that you and your finance team can use to review your tax position. We're also available to give a complimentary diagnostic. So if any of the issues that we've raised here resonates with you or your organization, we can have a very brief, confidential, complimentary diagnostic session with your company to see how we can help plug some of those gaps. Our next webinar is on the 19th of May. So take this as a primer to VAT. In the next webinar next month, we're going to be doing a detailed deep dive into VAT, and we're going to be looking at what is taxable, what is exempt, and what can you claim back under the Nigerian Tax Act. And so it's titled, Is Your Business Charging VAT Correctly? So you can just scan the QR code on your screen so that you can quickly join. You can quickly register for the next webinar. That's easy. So once it's time, you're already registered and you can join the next webinar. So we'll cover things like, VATable expenses versus exempt expenses. We'll cover zero-rated supplies. We'll cover the recovery framework, the distribution formula between the states, which created a lot of controversy during the time when, these laws were being drafted. And, so it's going to give you a more complete picture of the VAT system under the Nigerian Tax Act. As usual, we will send the training slides. The video recording of this session will also be on our YouTube page before the end of the week. We'll also send it to you via email. Also, the video of our last webinar on place of residence is also available on our YouTube page. So you can find us at Shelze PS or Shelze Professional Services on YouTube. Also follow us on social media, on LinkedIn at Shelze Professional Services. And you can just follow so you get regular tax insights and updates from us. On Instagram, you find us at Shelze PS. Thank you so much for your time. We really appreciate you taking our time on a busy Tuesday to be here in our webinar. We hope you learned a lot from this session. So we see you again next month. Thank you.
Thank you so much, Mr. David, and thank you so much, Mr. Iyanu. Make sure you have a good day today and see you on our next webinar on the 19th of May. Have a nice day.